you could make some good decisions based on the news events that you see or read about or hear about, but in practice it's really hard to do. Remember that the media survives by creating fear and hysteria. That's how they get us to pay attention to them. They buy their magazines, read their blogs, buy their programs, books, watch their shows. They need our attention in order to sell advertising because that's the only way they make any money. They don't get paid to help you or me make better investment decisions. And you know what? They don't even have the training to interpret financial events very well. Remember, God bless them, the people who write what you read are journalists. They're not financial experts. And I know this because they interview me all the time, and most of them, unfortunately, they don't have any idea what they're writing about. Not everybody, but many of them. And I did an entire video on the media and investing, and I strongly suggest that you watch it. Now, please look at the chart below. It shows how the market did from 2010 through 2017, and it was pretty good over the long run. But over those years, we had some major news events that hit the market hard. 2010, Greek debt crisis, market down 16. 2011, the government is close to default, down 20. 2012, European crisis, down almost 10%. 13, the market dropped almost 6% when the Fed announced that it wasn't going to stimulate the economy anymore by injecting cash into the system. In 2014, the market cratered 7.4% as a fallout from the global slowdown fears. 2015 down 12.4% as a result of more global economic fear, China's market decline, or collapse you could say, and Ebola. 2016, the market dropped more than 12% right out of the gates in early January, and a lot of investors were afraid that 2016 was going to be a terrible year, but the market ended up more than 13%. 2017 only had a minor blip, and it was actually very abnormally calm. But 2018 started the year with a big dip of 10% in late January in response to a weak dollar and inflation fears. Could get worse, we don't know, but I'm just saying if you react to these news events, you shoot yourself in the foot because they were actually blips on the radar screen. The news by itself isn't enough to take action on. They were corrections, not bear markets, and in earlier videos we looked at the differences between a bear market and a correction. Don't get me wrong, some news events are really worth paying attention to, but others are just noise, and as heavy as they may feel at the time, they should be ignored. But for now, there's a very important message that I want to share with you. And that is that the news of the day, in and of itself, it's hard to ignore, but it's a terrible indicator for investors if they want to make smart investment decisions. At least we've seen that historically. They have not been good markers. Now, what happens is people who use a certain strategy, even a numbers-based, well-articulated strategy, even those people find it difficult during a period of difficult news cycles, and they bail out or change direction, and they override their system. They do something contrary to what their investment strategy suggests that they do. And I understand why people do it, but it's really dangerous, or it can be. So realize that when you change your investment strategy based on news, or your feelings, or because the market dropped, you may think that you're doing the right thing, and you probably feel like you're doing the right thing. But I want you to realize that when you do that, no matter how smart it seems to do, you're surrendering your intellect and you're allowing your emotions to run your financial show. And as we saw, investors who do this usually end up only earning a fraction of what they otherwise might. According to Dalbar, who did a big study, they found that the average investor earns a half to a third of what their underlying investments earn. Why does that happen? Because we react too emotionally and too quickly. Look back to the chart of 2010 through 2017. It was a good period over the long run, but look at 2011 again. The U.S. government came this close to defaulting on debt. And that turned out to be a short-lived market correction, although a painful and scary one. Now, it could have been another 2008 financial crisis or much worse. I didn't know. It's hard to tell. But if you get out of the market at a big slide, even if you're able to do that before the big slide happens, how do you decide when it's time to get back in? How do you decide, how do you decide when something is a triggering event and when something is noise? Okay? Your financial future is too important to just leave that up to chance. And in the next videos, I'm going to start talking about how to differentiate between the noise and those things that you really should pay attention to. Thanks.